Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, how's the economy positioned for the possible storm ahead and designing the best policy for Canada minus the politics, plus making renting cool again. That's all ahead. First, for the week that was in business, it's time for the briefs. Election season kicked off this week with some spending promises, including tax cuts, $6 billion worth from Liberal leader Mark Carney and $14 billion worth from Conservative leader Pierre Poilievre. No mention yet by either on how to pay for those. The Liberals also promised $2 billion in support for auto workers hurt by tariffs, while the Conservatives offered tax cuts to seniors related to their RRSPs. U.S. President Trump announced 25% tariffs on all autos and auto parts not made in America. That takes effect April 3rd, a day after a full slate of tariffs are expected. It's unclear how the auto industry tariffs will be applied, as some parts will be protected for now by our free trade agreement. Concerns about tariffs and inflation drove U.S. consumer confidence to its lowest level since January 2021, with a decline similar to one seen last month as pessimism grows about the likelihood of a recession this year. Consumer spending drives most of the U.S. economy, so weak confidence can be a self-fulfilling prophecy. The liquidation of most of Hudson's Bay inventory began this week at 90 of its 96 stores. Customers thronged to stores in search of deals while the company was in court trying to forge a path forward. Severance for its 9,300 workers will not be paid, the Bay said, though their pensions have higher priority thanks to a 2023 law. The federal government has frozen $43 million in payments to Tesla under its EV rebate program. That comes after concern that Tesla inflated sales in Canada immediately prior to the end of the rebate period. The government also said Tesla would be excluded from any EV rebate programs in Canada as long as U.S. tariffs are in place. And those are your business briefs. It's a tough time to make economic predictions with tariffs on the one hand and new promises from an election campaign on the other. But here for some help, Benjamin Tal, Deputy Chief Economist at CIBC. Ben, thanks for being with us.
Thank you. A pleasure.
So often elections are really about the economy. It's what people tend to care most about, not the broad economy, of course, but their own personal micro situation. How would you say, absent anything else, people will look at the incumbent right now, the governing party, versus what's being offered as an alternative?
Yes, I think that people are relatively confused because what's happening south of the border is confusing everybody. And that's really the focus of attention now when it comes to economic policies. Who is going to fight Trump better? Clearly, if you look at the agendas coming from both sides of the political spectrum, they're getting closer and closer. The recommendations are getting very close to each other. If it's housing, if it's taxation, and anything else, clearly about Trump, the tougher you are, the better. So it's interesting times.
It's so interesting because, of course, affordability and inflation have been the key issues that have been occupying people. Inflation will be made worse by a tariff war, of course, and we may already seeing some signs of that. But that won't necessarily have political implications this time around. Are people able to separate the price rises they see in the future because they know it's coming from an external source, even though it was last time, Ben, as well, but they won't blame the politicians for it?
I'm not so sure about it. Politicians are very easy to blame. They are a good target. And if you are very upset about the cost of living, and there is a reason to be upset, food prices are in the sky and they continue to rise, people will look for something to blame and someone to blame, and those will be the politicians. It's very easy to blame Trump, but there will be other blames to go. So the next government will have to deal with Trump and the inflationary impact of Trump. Now, the Bank of Canada will have to see through it. So the question is what the Bank of Canada will be doing in this environment. I doubt that the Bank of Canada will be cutting interest rates in April because it's still not clear. But they say, and they are very clear about it, we are going to react very forcefully and quickly if things deteriorate, and they will deteriorate.
So interesting because, of course, if we get inflation because of tariffs, but also a recession, the bank is pulled in two directions. Which would you prefer to see them do? Stimulate the economy with cuts or fight that inflation with hikes?
I think to stimulate the economy, quite frankly, because this inflation will be short-lived. As long as it doesn't go to expectations, it will be just one-off and that's it. That's usually what happens with a tariff. Let's hope and pray that we won't get to this point. I think that at the end of the day, even when it comes to Trump does not have unlimited time. Time is not on his side, quite frankly. The economy there is suffering. The economy is slowing. Every day that passes reveals more wounds to the U.S. economy. You cannot sustain this kind of uncertainty forever. The level of uncertainty in the U.S. now when it comes to trade is higher than it was during COVID. That's crazy. It's unsustainable. It will come to an end at one point, and that's something that will ease the pressure on Canada.
One of the things we're seeing, as you do in an election, are spending promises. The tax cuts that are being offered by the Conservatives and Liberals, anywhere from $6 to $14 billion, depending on what gets implemented. Can Canada afford that kind of spending, or will it be good enough for the economy that it'll help offset the fiscal pain?
The short answer is absolutely yes. Our fiscal situation is actually better than most of OECD countries. We need to cut taxes in this country. We need to increase productivity, and cutting taxes is the best way of doing it, I believe. So the short answer is absolutely yes.
Ben, so good to have you for this. Appreciate your time today.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Coming up, we're often told Canada is doing terribly economically, but is it really? Stay with us. Welcome back. We've heard a lot of talk about how poorly Canada is performing. Well, here's a fact check by the numbers. At $2.3 trillion, Canada's economy is big. It's easy to feel small, perched next to the U.S., but it's the 9th largest in the world, and absent some rude interruptions, was tracking for 2.4% growth this year. Per capita, that's $55,878 per person, also making us among the world's richest people. It's above the OECD average of $46,266. And it's worth noting that while our total economy is 9th, only 2 of those with bigger economies have bigger per capita GDP. The U.S. at $89,680 and Germany at $57,910. Countries like the second biggest economy, China at $19.5 trillion, has a per capita GDP of $13,870. India's $4.3 trillion economy translates into just $2,940 per person. If you're getting the through line that larger populations can make it harder to spread wealth, you may be onto something. One reason Canada's per capita GDP has suffered is because our population has grown by 3.2% in 2023 alone, the fastest rate in our history and in the G7, putting our total at 41.5 million by the end of last year. Other measures bode pretty well for Canada. We're the happiest country in the G7 at 18th globally, according to the World Happiness Ranking. And our Gini coefficient, or a measure of equality in our society, is 0.34, better than the United States and China. And for all its flaws, our healthcare system stands up too. Canada ranks 4th globally by World Population Review. The biggest problem with it? There's not enough of it. Access is high on the list of issues. We do well on lifespan, infant mortality, and on acute care. One problem we do have when considering how well we're doing is how we measure our economy. It may not be very good. Brian Lewis is a senior fellow and sessional lecturer at the Munk School of Global Affairs and Public Policy. He's also a former chief economist with the province of Ontario. Brian, thanks for being with us.
Great to be here, Amanda.
I want to talk specifically about GDP. We measure our economy. It's like a baseball score with other nations. And yet, is it actually measuring what really matters?
No, it's not. It's convenient because, it's a conventionally used measure that allows us to compare across time and across other countries. But it's not really measuring the most important things. Ideally, we'd like to measure living standards or quality of life. That's really hard. But we could do better by at least focusing on income. GDP or production is just a means to an end, which is wealth creation. And income indicators would do a far better job of measuring how well Canada's economy is measuring up.
Even there, it's interesting. We've heard a lot about productivity. We think our productivity is suffering. However, the Bank of Canada did some research showing that if you take the top 10% of income earners out of the mix, our productivity is the same as the U.S. In other words, even that measure, Brian, you can slice and dice, and it might not be all it's made up to be. So what are the measures you think we should look at? Is it things like happiness, affordability of housing, which we're not doing very well on? What would you point to?
Yeah, there's a range of indicators we would use, but if I had to pick one, I think we should focus on national income rather than national production. And because of the value of Canada's natural resource wealth and our ability to export that wealth on increasingly favorable terms, our income growth is much faster than our GDP growth. Income's growing faster than production. And I think we should focus on that because ultimately I think it's income that matters to people, not production.
For sure. And of course, there are other things that are really hard to measure. Many people were struck that on a per capita basis, according to the Economist magazine, we're equal to the poorest state in America, Alabama. But on every measure that you might think matters, like how long you live, how healthy you are while you're living, how much money you have, we are, of course, way above Alabama. So in terms of how Canadians feel about themselves, do you think getting these sort of bad indications, this negativity, is a negative? Can it be self-fulfilling?
That's one of the things I worry about, Amanda, having Canadians feeling bad about our economy and, frankly, the Canadian economics community feeding into a negative image of the Canadian economy globally is ultimately bad for us. It makes people actually start to wonder if this is a great place to invest. And I think that's totally inaccurate. But it could have detrimental impacts, this sort of productivity hoax.
And I guess I would add, at a time like this, when we are under threat from our biggest trading partner in a variety of ways, maybe tooting our own horn becomes even more important?
Absolutely it does. I think the Canadian economy is highly sophisticated, highly successful. It's different than the American economy in a number of different ways. But I think we've got enormous advantages in Canada. I think it's a highly successful economy, and I think we should, as you say, be touting those advantages.
Brian, so good to have you for this. Appreciate your time.
Great to be here.
Brian Lewis is a senior fellow and sessional lecturer at the Munk School of Global Affairs and Public Policy. However you think we're doing economically, most people agree that government spending has risen pretty fast. Reining it in should be a top priority for the next government, according to many. Bill Robson is president and CEO of the C.D. Howe Institute. Bill, thanks for being with us.
My pleasure.
So government spending as sort of a proportion of the overall economy has been very much in focus. Are you of the view that whoever is governing after this election, they should try to get it back into a different, smaller size?
I totally think that they should, and I'll just start with the value for money argument. If we're looking at the federal government, the way the head count's gone up, the way the salary bill has gone up, and then you look at what's actually happening with the services and so on, it's not at all clear that we're getting value for money. And we need room to get some taxes down. Trump is reminding us of the importance of being competitive, and the bottom line matters as well. We just can't keep borrowing indefinitely. So one of the things you have to do before you can really think about anything else is get spending under control.
Of course, we have some promises being made here. Now, promises aren't laws, but if they do follow through, anywhere from $6 billion to $14 billion of tax cuts are being offered here. Do we assume that there will be government spending cuts to match that? I assume we're not going to move into an era of deficit financing tax cuts.
Well, that's kind of the era that we are going to go into if we don't watch out. One of the things that I don't recall having heard as much as I think we should be hearing during the election campaign is about defense spending. Mm-hmm. We've got this commitment to get up to 2% of GDP. It's a bit of an arbitrary number, but when you think about what Canada really ought to be doing just in its own naked self-interest, especially with the United States now looking a good deal more antagonistic, there's a strong case for getting, I'll say, in our shadow budget, we propose that by the end of the projection period, defense spending be about $16 billion annually higher. So you've got that to deal with as well. And if we don't get the rest of the spending under control, it won't just be the tax cuts that are being financed with deficits, it'll be the defense spending as well. And that's really not a very durable base for any commitment that's going to last decades into the future.
Yeah, fair enough. One thing that we've seen governments do, and we're talking today about how we measure things, we talk a lot about what we're going to spend on things. Would we be better off being more focused on the results of that spending? And that may sound obvious, but very few businesses tell you what they're going to spend on their sales team. They tell you what their sales are. Could we do better in government at changing the incentives and the outcomes?
It's inevitable, it seems, whether you're a provincial government or a municipal government or the federal government, that there's going to be a lot of, I'll show you how much I care by how many zeros are on it. Mm-hmm. The federal government doesn't deliver a lot of things that are really kind of day-to-day things. I think if you're in a province where you're doing health and education, if you're a city, you got to do the roads and the sewers and the garbage. There does tend to be a little bit more of a focus. And in the federal government's case, one of the things that's really missing, they do have a formal expenditure review process process, but you can sort of tell by the results that it hasn't been working well. And they could do a lot better on that. And I think a new government, not talking about going in like Elon Musk and breaking things, but just doing some good old-fashioned cost-benefit analysis. And when you see money that's not yielding the result that you want and you've got competing uses for it, including tax cuts, don't do it.
Only about 30 seconds here, but do you think that getting back to balance will be something that any future prime minister will have in mind? It's been a while since we've had that as a view.
0 on the bottom line is a magic number. I do not think aiming at some sort of debt to GDP ratio is an effective constraint. When you're around the cabinet table or just in the PMO, somebody has an idea to spend $1. Right. It's much more effective if somebody says, okay, fine, we got this bottom line target, so you're going to spend $1 less somewhere else or raise $1 in revenue. Changes the discussion in a way that's just got to be for the better.
Bill, so good to have you for this. Appreciate your time today.
My pleasure. Thanks for having me.
Bill Robson is president and CEO of the C.D. Howe Institute. Coming up, building enough housing for Canadians might involve changing how we live. That's still ahead. But first, home genetic test company 23andMe has filed for bankruptcy protection. That's a process that might allow it to keep operating while it explores its options for sale. Its biggest asset is the genetic information of 15 million customers, raising some concerns about the privacy of that data. Some customers are rushing to delete accounts in hopes of protecting it. A bit ironic, since it was a big privacy breach that rocked 23andMe in the first place. We're thinking privacy just wasn't in the company's DNA. We're back after this. New Canadians and seniors are a stable part of the rental market in Canada, but is it time for other Canadians to think about renting longer term? The feds recently put $2.5 billion into a loan program for construction of rentals in Toronto, but we're still a long shot from the housing we need. Adrian Rocca is founder and CEO of Fitzrovia. Adrian, thanks for being with us.
Thanks for having me, Amanda.
So, of course, the lack of available housing has been a preoccupation in this country for years. The rental market is a really important part of it because it's often a starting place for people before they buy. It's a place for new Canadians. But should we think differently about renting? Should we shift a little bit away from that vision of the home as this home we own, with the white picket fence, and make renting a little bit more friendly to everybody?
Yeah, look, we firmly believe that should be the case. There should be a shift away from not only a single family home, but I would argue high-rise residential product that's been built for the last 20 years in Toronto definitely does not lend itself to young families or downsizers looking for larger, more livable units, 2-3 bedrooms. And also on top of that, some of the lifestyle programming and kind of creating a strong sense of community, we think is fundamentally important, especially for new immigrants that have a 70% propensity to rent when they land within the first 5 years in Canada.
One of the things you do at Fitzrovia is try to do a bit more of a wraparound in terms of attracting people and giving sort of a value add. Just describe how you think about building things that will make people want to live there.
Yeah, so we really want to identify our end consumer that we target, and really depends on the neighborhoods that we're developing in. It could be a young professional, it could be a young family, it could be a downsizer, it could be a more mature family as well. And what we'll do is look at how they tend to live, what is the demographic profile, how do we actually make their living experience an exceptional one. So that starts with the size of the actual suites. Will typically be about 20 to 25% larger than what you typically see in the condo business. So just to frame out specific areas, 2 bedrooms will typically go at 650 to 700 square feet in the condo new product today, and will be around 840 to 900 square feet. We have a lot of 3-bedroom units of around 1,100 square feet. We'll do full islands, full kitchen runs, full-size appliances, closet organizers, integrated desks, mudroom concepts, extra large, washer dryers with additional storage space to actually tuck in a stroller. Right. And then actually, when we look at the amenities specifically, we very much want to replace a gym membership. So we'll do 7,000 square foot gyms. We have, our own school that plugs into our young family buildings. It's called the Bloomsbury Academy. We're going to be one of the largest private school operators in Toronto. In the next 5 years, we'll have 6 schools that open up.
And just in terms of the overall market, I mean, can you build enough and others like you to satisfy the demand? We're millions of homes away from getting this market level.
Yeah, we are very much undersupplied. So if you actually look at the next 3 years of deliveries, so this year we're seeing downward pressure on rental rates and lease velocities. We have 26,000 units that are hitting the market all in one shot. Right. So that's a good thing for the end consumer, not a good thing for, I'd say, the developer or the investor behind this product. Yeah. But definitely a good thing for end consumers. If we go back to what's gonna actually deliver in 2026 and 2027, it drops to 16,000 units. And in 2027, it's 7,000 units. We really need a run rate of 40,000 units to actually have a structural vacancy level that's at an equilibrium point. And so we really need to ramp up new construction. Right now, the economic model is largely broken, right? New starts are down. If you look at that data, 60 to 70% from peak production 2-3 years ago. Right. So we have to get margins expanded to the point where it actually encourages institutional capital and private capital to get off the sidelines and invest in vertical development.
We got to leave it there, Adrian, but it's so good to have your voice on this. Appreciate your time.
Thanks for having me. Thanks, Amanda.
Adrian Rocca, founder and CEO of Fitzrovia. Time for the takeaway and eyeing the damage from a bull and a China shop. Relations between Canada and China haven't been great in recent years. Just last week, China put new tariffs on Canadian goods, 100% on canola and peas and 25% on seafood and pork. China says they're in response to Canada's 100% tariffs on EVs. But things were frosty before that, thanks to Canada's arrest of a top exec at Huawei and the subsequent decision to ban that Chinese telecom player from our 5G wireless network. Security was the reason, namely that China was not to be trusted. Canada got in line with its big allies and locked China out. But what a difference a few years can make. This week, China hosted a global business forum attended by CEOs of some of the world's biggest companies. The message from Chinese officials? Freer trade is better for all, that open markets lead to better global security, and that China is a good destination for foreign investment. Businesses like Apple, Pfizer, MasterCard, and Cargill are probably happy to be reassured that they can renew investment in a country that represents such a big opportunity. What makes the timing of the message so interesting, of course, is the stark contrast with the messaging from America these days, and in particular, the tacit acknowledgement on China's part that its own economy will lose if it's shut out of global trade and investment, unlike the U.S., which seems oblivious to the damage it might do to itself by closing its borders to trade. Meanwhile, countries like Canada have a decision to make about China. Do we continue to grow trade with it or not? There are good arguments in the not column. It's a country that doesn't always respect the rule of law around trade and international borders. It can be a bit of a bully in order to get its way, and it may not be a friendly ally. But now that every one of those descriptions could be made about Canada's biggest trading partner, the U.S., maybe our perspective changes a little. My takeaway? Canada will have to think carefully about its path when it comes to China, but there is no doubt that a less friendly America changes the parameters. That's Taking Stock for this week. I'm Amanda Lang. Thanks for being with us.